I'm Michael Mandel. I'm Comstack's CEO, and I'm here with Ali Bauman, who is our head of real estate intelligence at Comstack. And we are very excited to talk to you about what happened in 2024, our 2024 wrap up, and 5 trends to watch in 2025. So that's us. You can see we look just like that. I'll turn my head a little bit so you get the full effect. There we go. All right. So we're going to dig right into this here. Here's what we're going to cover. Biggest trends from 2024 for commercial real estate and for the economy more broadly. Specifically, we're going to talk about office, industrial, and other real estate subtypes. And we're going to review what happened in 2024 and then give you our predictions for 2025. And then a year from now, we'll talk about what we were right and wrong about, which will be very exciting. But I expect we'll be 100% right about everything because we can predict the future at Comstack.
Absolutely.
So we're also going to review some polls that we put on LinkedIn where we got your opinions on what you think will happen in 2025, and we'll see if we think you're right as well. So we will start with key economic themes for 2024, where we are now and what's next. We'll each cover these, and then we'll get into all the really smart stuff from Ali, and then I'll pretend to be smart along the way. So getting started, obviously interest rates were a huge topic of conversation at the beginning of 2024 and continued to be. Everybody was anticipating whether there would be rate cuts, what kind of rate cuts there would be. I think there was certainly anticipation that there would be some level of rate cuts in 2024, but we weren't sure when. Certainly, it took longer than I think a lot of people hoped. We finally saw rate cuts, going into, the end of the year, and ultimately we had 3 rate cuts, but didn't make a huge impact in comparison to the 11 rate hikes that we had going into the beginning of the year. So ultimately, we got a little bit of relief, and that helped the market thaw a bit, but maybe not as much as many people would hope. As for 2025, we think that more rate cuts are unlikely to happen immediately. Particularly, we've seen that while the Fed funds rate has gone down 1%. Ultimately, 10-year treasuries are still pretty high. The market hasn't moved too much yet, and I think the Fed's going to want to continue to see more signs that they're really making an impact on inflation before they make more cuts. So, that's certainly going to put a bit of a damper on the market, at least for the beginning of the year.
Thanks, Michael. And obviously, a big part of the past story about interest rates was the Federal Reserve was also paying attention to the job market, what's happening with job openings. We now know that, for most of 2024, the key theme was that job growth was steady but has moderated a bit. Going back to January 2024, we had an unemployment rate of 3.7%. Job market was still running pretty hot then. It was a near cyclical low for unemployment, and it was the 36th straight month of job gains. At year end, things haven't changed that much. Job market cooled slightly. The Federal Reserve has been happy to see that. The unemployment rate is now 4.1%. Actually, they just announced January, it's 4.0%. And the Federal Reserve has said that, they're now no longer concerned about the hotness of the job market. It's more kind of the CPI increases and concern about other policy changes from the new administration that might have an impact.
So there's not probably a lot to say about the presidential election that hasn't been said a million times over, but obviously, the market was patiently waiting to see the outcome of the election combined with the rate cuts that we talked about before. And so that definitely put the market a bit on pause until towards the end of the year, because they wanted to see, if Donald Trump won or Joe Biden won, and then later Kamala Harris, obviously. We certainly are seeing a lot of activity from Donald Trump that will impact the economy and is already beginning to in some capacity. And so we expect that that's going to create, an impact in the market in 2025. But a lot is in flux right now, right? Because there's still the impact of interest rates. Tariffs are certainly something that we're looking at as far as the impact on the market, both for good and for bad. And the federal job cuts are notable as well. So there's a lot happening as a result of the new presidential administration, and certainly expecting to see things be in flux, and we'll see when and if they ever stabilize.
Yeah, I think that makes a lot of sense, Michael. We don't know, but what we don't know. So one of the other big themes of 2024 was what's happening with lease transaction volume, what's happening in the leasing market. So overall, we saw for the office market, unfortunately, it was kind of a fourth straight year of continued strain. Whereas for industrial, I'd say it's a period of moderating growth, reverting to sort of a pre-normal before COVID. In January 2024, it's notable that leasing volumes for office were down year over year, but also for industrial. And both were, so for office, it was down from the pre-COVID average, more than a quarter. For industrial, it was down from the 2022 peak. So that was a year where in the industrial sector, more than 1 billion square feet was actually leased. So we were down from that peak in that time. Where are we at year end 2024? Office volume was down slightly from last year, but not dramatically so, but still down from the pre-COVID average. For industrial, it was down about 7% from last year. And what are people expecting for 2025? For office, seems like we're expecting a bit of a better year in 2025, but not dramatically higher. I think it'll be a few years before we can get back to a pre-COVID average. And again, for industrial, we're expecting that we'll see stabilizing lease volume, but sort of reverting more to the lease volumes that we saw before COVID and not reaching those 2022 highs.
So on the commercial real estate sales transaction front, interestingly, sales volume went down a lot in 2023. Not a huge surprise, but I think what might be a bit surprising to many people is that the transaction volume stayed roughly the same in 2024. So while there was some optimism, I think it came too late in the year to have a meaningful impact on sales transactions, and certainly the way the year started, hurt transactions at the beginning of the year. That said, we are expecting improvement, in sales transactions. The delay in kind of meaningful interest rate reductions will temper it a bit. That said, I will say on a personal level, as CEO of Comstack, we've noticed that our customers have become more optimistic, and more people coming to us to sign contracts as well. And we think that's a bit of a leading indicator, right? We're seeing people coming to us who are expecting to do more in 2025 and are looking for the data to do it. And so we're seeing a lot of optimism from our customers, from our prospects. And I think there's a bit of a pent-up demand. There's a pent-up desire to be optimistic. People are trying to find reasons to do deals instead of finding reasons not to. So I think we're going to see some improvement in 2025, but I think it's going to be a bit tempered. It's not going to be a doubling in the same way that we saw the transaction volumes cut in half from 2022 to 2023. All right, so our first topic here is office flight to quality. And I'm going to hand it off to Ali, who is going to say all of the very smart things about that.
I will try to say as smart things as possible. But yeah, flight to quality, I know it's been covered many, many time again, but still worth revisiting as it's been kind of the dominant trend. So first we'll give a quick overview of like what we covered last year, 2024, which I'm still getting used to saying. I keep calling it 2023. Last year was 2024. But so we covered this in our mid-year report on the office market. We cover 11 gateway markets in that report. And we were paying attention to what's happening with flight to quality. quality. Here we kind of break it out into prime class A, which is anything trophy, new construction, recently renovated class A, the rest of class A, which I'll call class A minus, if you will, and then B and C product. And you can really see in the green line that it started increasing from the end of 2021. This here is showing the change by quarter, every quarter from 2019. And so you can see like it really started to pull away from the other sectors at the end of 2021. But what's interesting, and we saw this at mid-year, is that we started to see some uptick for the rest of class A and then a little bit for B and C. So we started to wonder, is flight to quality peaking, and is there going to be movement for other sectors? And of course, like the other part of the story for flight to quality is, tenants looking at top tier space, whether that's new construction, trophy. And we've seen, for the gateway markets overall, but particularly for Manhattan, a market like Manhattan, is that the share of deals going to triple digit leases has really increased over the past several years. In 2024, more than 17% of leases signed in Manhattan were with in a triple digit range. So we thought that that was something definitely notable to mention. And
So we did
Michael,
a
what did
poll.
our poll?
Yes, we did a poll, and we asked you all, will the flight to quality, continue, and or will we see this go from top tier space to A minus and B plus buildings? And overwhelmingly, we saw the answer from our poll that people believe that A minus and B plus space will rise, and we are going to give you our opinion on that. And we believe that it will. So I'm going to hand it off to Allie.
Yes, and we didn't influence the voters of the poll. They chose that all on their own, that A minus and B plus space would rise. So one of the main reasons that we think this, and people have been talking about this a lot, is that there's sort of a shortage emerging in top tier space. It's in shorter supply, especially brand new construction. The chart that's on the right shows the square footage of office space under construction. This is CBRE's data, and they showed that it's been declining over the past few years. And also, if you look at office completions, not just what is under construction, in 2023, it was less than half of what was delivered in 2019. And we think that 2025 will be even lower. So we have plenty of evidence of kind of top tier space sort of running out, especially in a market like New York. Every year we put together the top 10 leases by highest value, that is total lease consideration in Manhattan. And so you can see for 2023 and 2024, there's a lot of red in that chart. And that's because the vast majority of the deals were in existing buildings, not new construction or even a majorly redeveloped building. And I think that's just simply because there's a shortage of large blocks that are available in these types of properties. And then further evidence of why we think momentum is going to flow to other Class A and B plus space is showing up a bit in recent rent data. So in contrast to the prior chart that we showed, which only went through mid-year 2024, now we're showing through year-end 2024. And we can see that prime is at the highest level among the periods shown in this chart, but we're also showing in the middle the rest of Class A minus, if you will, that has been increasing for about 6 straight quarters. And then if you look at Class B plus, which we defined as sort of buildings built after 1980, recently renovated also. And I know there's lots of debate as to what any of these classes mean, especially what Class B plus. But we could see that there's early indicators that rents have been increasing over the last several quarters. It may be too early to tell, but it's something we're certainly paying attention to as these large blocks in prime space are become more rare. And so I'd say, the market is pretty nuanced, especially when you look at the vacancy rate. So the US vacancy rate is still near peak. It decreased, slightly last quarter, most people are reporting. And there's a big spread between the vacancy rate for prime space versus non-prime space. And even still, the vacancy rate, when you look at it nationally for prime space, is still above where it was pre-pandemic. So maybe a little bit early on this trend, but we think we'll see more movement, and we would look for that to show up in runs, increasing activity, transaction size, and possibly lease term in the quarters going forward.
Yeah, and I'll mention on that, there's a lot of variation across markets here, right? So the data we showed, covers the country overall, but we're certainly hearing, different markets are stronger than others. In particular, we're headquartered in New York, and the feedback we're hearing, from our clients, we have almost all of the, Class A owners in New York as major owners in New York as clients, and several of the, Class B owners. And the feedback has been that, the number of tours they're doing, the number of leases they're signing, the activity that they have is just massively higher than it's been over the last couple of years. And so New York certainly is at the forefront of this trend, and we're hearing that that activity is across the board, across the assets that they own.
Yeah, that's a great point, that we've been hearing that.
So moving on to industrial rent growth, where are we, Ali?
Okay, so industrial rent growth may seem like old news now, but we started to cover in early 2024 industrial rent declines, which at the time we wrote a report with Savills, and we weren't the only one that was saying it, but we were one of sort of the more negative on the market, that we're starting to see industrial rent declines, especially in some major markets. So this chart maps in early 2024, we're looking at effective rent, comparing it to its most recent peak, and also comparing it to sort of a pre-COVID average, which would be 2019. And we started to see that a bunch of markets were sort of at peak or had fallen slightly from peak, with larger declines from peak from a market like LA, Orange County, Inland Empire, which of course has been the nation's outperformer over the past few years. And if you look at this chart, this zeroes in on effective rent by month, actually, compared to year-over-year change in effective rents through that early 2024 period. And we started to see that there was 17 straight months of declining growth, meaning the rate of growth was getting slower through early 2024. And so this is something that we wanted to follow and pay attention to. And this was sort of the leading market that started to show the softness first. And that is sort of where we were at early 2024. Now we want to know what people think will happen for next year. So, Michael.
Yeah, so we asked our users, and we asked our community on LinkedIn, with demand softening and supply increasing, will we see a continued slowdown in industrial rent growth? And most people felt that rents will stabilize, but a good number of you felt that rents will keep declining. And we're going to dig into that now.
So our answer to this, and maybe we're cheating a little bit, but we think that it's kind of both of those answers, that it's really a nuanced market, sort of a bifurcated market, that certain parts of the market with oversupply are going to lag, perhaps decline a little further, while others will stabilize in sort of our next part of the cycle here. And on the next few slides, we'll dig into why we think that is true. I'm not surprising that it was kind of split. 2/3 thought it would stabilize, 1/3 thought further declines, and that may be like a factor of like what market you're looking at most often. When we look at data that now goes through the end of 2024, that's exactly what we saw on a broad, average across the 8 major markets. We've seen declining growth rates, but declines seem to be slowing for both effective and starting rents. When you look at this major market average that we actually last covered in the end of 2024 in our biannual industrial market report. So rents seem to be holding at this level. You'll see over the last quarter, they're down from peak. They're not growing anymore. So broadly, it seems to indicate that things might be stabilizing. But our view is that the industrial sector is really 2 kinds of markets. So this is comparing Phoenix and Houston, 2 major industrial markets that were actually mentioned by Prologis in their most recent earnings call, I believe, as kind of 2 markets that stood in contrast to each other. They were starting to see rent declines in Phoenix, which largely they cite because of, an influx of new supply. Whereas actually they're starting to see, rents hold or actually increase in Houston, which is notably a market where there hasn't been that much built in the most recent cycle. So here, we're showing a similar thing. You can see like through the 2022 to early 2023 period, this is comparing year over year growth. You could see that Phoenix like well exceeded what was happening in Houston. But in the most recent quarters, it's kind of shifted. Houston is beating Phoenix in the most recent quarter. So it's kind of like, an interesting shift to pay attention to. And so you dig into kind of the supply sort of side of the story, and here you can clearly see sort of the difference in how like Houston and Phoenix have trended, when comparing back to 2019. For a market like Houston, it's still up, considerably from a 2019 level, up 45% in terms of the average effective rent. But Phoenix is twice that, up by 89%. But if you look at the year over year change, you could see how much Houston is sort of increasing now. And the story here is that, Houston, even though it's a bigger market overall, its 2024 deliveries were just 2.5% of its inventory compared to Phoenix, which was 7.4% of its inventory last year. So it just goes to show that there's, a bit of a supply demand mismatch in these kind of markets.
It's worth noting, I would say, as well, when we did our mid-year industrial report, if I recall correctly, we looked at the top 10 industrial leases and that renewed, and the top 10 renewals, and the average renewal increase was, what was it, 61% or something like that, I think, from the previous rent.
Yeah, yeah. And I think that's, a big part of the story worth mentioning, that even though rents are declining in some markets or stabilizing, industrial leases are, relatively short. So even if you signed in 2020, 2021, you're still going to be below market when your lease comes up for renewal. So it's not really that the sky is falling for the industrial sector. If I was an industrial tenant, maybe I'm a little bit happier I'm looking now than I was looking, 1 year ago. But yeah, I mean, that's definitely something worth mentioning, that there's still, sticker shock in the market, even though you've seen, kind of increasing concessions and that sort of thing.
Yeah, and if you're a long-term industrial owner, you don't have a ton to complain about. You're still doing pretty darn well, compared to where things were. So ultimately, industrial is still in a pretty good spot, even with a little bit of softening. All right, so we're going to talk now about office leasing, and specifically, we're going to talk about the industries that have been stronger in 2024 and where that's going to go next in 2025.
Yes. So, despite leasing being down overall in 2024, what we saw last year was a lot of presence by what I would call traditional office industries, so law firms and finance, insurance, and real estate, with probably a heavier emphasis on the financial services part of FIRE. But, we've seen in the past few years that they're they're accounting for a higher share of overall leasing activity than they did in prior years, but also as compared to 2018 and 2019. So in 10% higher in some cases. So last year, about 33% of activity across gateway markets came from these sectors, and that's up from 25% in 2019. They've been more present in the market. That could be for lots of different factors that we talk about. They're back in the office more. They have requirements, especially for the financial industry, but they also may have the money to be taking advantage of the opportunities to grab top tier space that may be a much better deal than they could have been able to negotiate for in past years. And here you can see we put out a top deals list every quarter, and just how many of the top deals across every category, effective rent, relocation, came from, these sectors, with one of the biggest ones being, of course, Blackstone, who completed an extension and expansion last year in New York City. And again, mentioning this top 10 deals of New York City by value list that we put together, you could see further evidence of the dominance by law and fire in the past 2 years. So 14 of the top 20 deals the past 2 years were in fire and law. And a little bit of hint here, but you can see that Tammy has been more absent recently, in a contrast to what we saw in 2019, and then even in like the earlier COVID period, 2020 and 2021, when they were a little bit more active in the market before kind of taking a step back.
Allie, why don't you tell everybody what FIRE and TAMI stand for?
Yes. So Tammy, yeah, is not a person. But Tammy is a collection of industries that includes tech. It includes big tech. It would include AI, which of course is a bit of a newer source of demand, which I'll actually talk about next. And then it's advertising, and media, and information as well. And FIRE is financial services, so that would include anything like hedge funds, banks, private equity, insurance, so health insurance providers, other kinds of insurance, and then real estate. So um, you know, like an SL Green or something might be included as part of that. So something we also covered last year as more of kind of actually from a sort of predictive kind of standpoint. We wrote a report with Savills actually early 2024, focused on San Francisco, which at the time was really suffering from no lack of negative news. And this was sort of around the time when we're feeling all excited about AI. And so we covered it from the aspect of like, will AI be enough to help San Francisco and sort of take it back to a brighter time and sort of take care of some of the double-digit vacancy. They've sort of been the highest vacancy rate national for a while. So at that time, we didn't see that there had been many new AI leases yet, a lot of promises, but we took a look at our data comparing against a huge list of AI companies. And of course, it's a little bit murky, like everyone's using AI. So what is an AI company? But we can see that there has been an uptick in the share of leasing activity in San Francisco and Bay Area that's going to AI firms. And so it's up to about 8% of activity last year. New York is another market that people are paying attention to, and maybe it's a bit early. There's been an uptick, but really it's a small source of demand so far, even though we've seen a few deals from OpenAI and others.
All right, so let's jump into our poll of where things are going to go in 2025. And we asked what are the sectors people are going to be interested in, and we are hearing other big tech will return, AI firms will drive new demand, but some people still think finance and law will lead, and nobody thinks that there will be a change, or that there will not be a change, rather. So let's go into our prediction, and we think that Tammy is back. So that's going to be our big prediction that we'll see next year if we were right, but we believe Tammy's back. Fire and law are on a relative basis out for the office sector. Let's dig into why.
Yeah, thanks, Michael. And please jump in here because I know you have some interesting views on this. And I think it's a bit of a contrarian view, but one that is, very likely to happen. Tammy, which would include AI as part of it, as well as big tech companies like Amazon and Facebook will be included in this. So we think that they will be back in the market in 2025. Now, here you can see just how much their share has changed in recent years relative to like a pre-COVID period, actually going back to 2015. So, for the past 3 years, remember, these companies, especially big tech, were a little bit active in the kind of 2021. There was, major deals signed in New York. Facebook signed its, 1 million square foot lease, I think, at the Farley building after, COVID began, and they were totally working from home, which surprised everyone. But, their share has fallen over the past 3 years or so. And so why does that matter? Well, we took a look at, what we have as far as lease expirations, and you can see the line in blue is Tammy. For 2026 and 2027, you could see that they're accounting for a higher share, an increasing share of lease expirations compared to where they were in the past couple of years. So in 2026, there'll be 26% of all lease expirations, and then going up to 29%. So these would be the years, if your lease is expiring, you probably in the market now trying to figure out like what you're going to do, making space decisions if your lease is expiring then. And then another good point is that, while office using employment is way less correlated to office demand overall than it used to be, it's not meaningful. So TAMI employment is still way up nationally from where it was in 2020 and even 2021. And it's slightly outpaced, growth in the rest of the private sector. So, employees are there, they're just working, have different styles of working. And so if these tenants have, an increasing, return to office policy or something changes there, that could also influence greater demand. And Michael, I think you had
Yeah.
a view about, what might be influencing their policy there.
Yeah, absolutely. I think, well, first of all, tech has been a laggard, right? The financial and insurance, industries and real estate were coming back to the office more days per week sooner than tech. That's now shifting. Everybody saw the news about Amazon being back, 5 days per week. Obviously, there was, speculation that this was just a means for them to effectively do a layoff without doing a layoff. But interestingly, a lot more people stayed on and did not quit than they maybe thought would. And then they had to delay their return to office 5 days a week because they realized that they didn't have enough office space to actually bring everyone back to the office. And so now Amazon is focused on leasing new office space to accommodate everybody coming back. And they recently signed a deal in Wynwood in Miami, which was, quite notable. And so I think we're going to see more of that. And then I also think, you've got to look at the political environment that we're in right now. And it would seem that the tech CEOs are all now, best friends with Donald Trump and Elon Musk. And, certainly Elon Musk is driving Doge and the effort to get everyone back in the office in the government. You've got I think that's going to influence, more broadly the economy. And, you've got the changes in policies around DEI that, at Google and Meta and things like that, which I think are correlated to just generally, the leadership of these companies taking a very, Donald Trump friendly approach to the way they handle their business practices. And I think that they're going to want to bring their employees back to the office as part of the initiatives that they're taking. And so I'm very bullish on tech office space occupancy, given all these factors, the lease expirations, employment, combined with the political environment, would all indicate that we should see a rebound in TAMI.
Yeah, and another recent Amazon deal, Michael, I think was happened today that they're signing. I'm not sure if it's in a WeWork or if it's with WeWork, but they signed another 100,000 square foot lease in New York City. So we're already well on our way to being correct.
Wow, it's like we took a time machine back. It's everything old is new again. Everybody signing big corporate signing big deals with WeWork. Who would have thunk it?
Yep.
All right, let's talk about bulk industrial.
So earlier we talked sort of in general about the industrial sector, but I think a big story of why industrial became, such a hot sector and the rent growth was sort of these major mega deals. Broadly, most people define sort of bulk industrial as transactions that are 100,000 square feet and above. But of course, there's, variation that like during the sort of hottest period of the drive up in rent, Amazon's taking deals of 1 million square feet, 800,000 square feet, and that happened, on the regular. So, what we noticed, last year is that we were seeing a significant drop in average transaction size, especially for Class A buildings. And then we also saw a sharper drop. Well, we saw a drop for both kinds of transactions, below and above 100,000 square feet for lease term, in sort of a desire for more flexibility, perhaps on both the landlord and the tenant, but we saw a sharper drop for those larger transactions. And what everyone cares about. So when looking at rent growth, we saw last year that for transactions that are larger than 100,000 square feet, their rents dropped more from their most recent peak, for this part of the sector. So when we pulled the data now through the end of 2024 and broadly across our 8-market average, it's down 3%, from its peak at the end of 2023.
Great. All right. So when we think about what's going to happen in 2025, we ask you all about what you're optimistic about, and are you more interested in small bay, bulk industrial, or neither? And generally, we had a tie here between small bay as well as just generally industrial recovering across the board. But shortly thereafter, there's 27% of you who felt that demand would be muted across the board. So definitely a split opinion here, but not too many people feel that the large users are going to be back, in bulk industrial in and of itself will be strong.
So yeah, looking
So
forward.
go ahead.
Oh, you can announce it, Michael. I will.
So our prediction for 2025 is that small bay multi-tenant industrial will outpace bulk industrial, and we have good reason to say so.
Of course. So yeah, we paid a lot of attention to bulk industrial last year. And as I said, we saw, faster declines for that sort of sector, across, many metrics. But, we've been hearing more buzz about small bay industrial, smaller buildings. But what we've also learned as we research more about it is that, like many things in CRE, the definition is a bit, up to interpretation. But in general, it's smaller buildings. I asked my good friend Mark Russo at Savills, who we've collaborated with, for a chart that shows kind of the vacancy rate by building size range. So there's a debate about whether small bay, is it the building size, or is it the transaction size, or is it both? I think in general, most people land on that it's smaller buildings and then perhaps, multi-tenanted spaces. But here we're just looking at vacancy by building size. You can see that buildings of 200,000 square feet or smaller, vacancy rates have trended up across all building size tranches, but are lowest for buildings that are lower than 200,000 square feet and appear to be stabilizing a bit more. Notably, what's interesting on this chart, that like for those mega buildings that are above 750,000 square feet, that's higher, but also stabilizing. But then it's like the middle of the road, buildings, which, it's still accommodating bulk industrial users, are still trending up. And again, as I said, because it's, a bit challenging to define, what is small bay industrial, Mark and Savills actually came up with this way of defining it. So comparing the tenants in the market, that are of an existing size range to the availabilities that exist in the size range. And so when you look at it that way, you can see that for these 3 major markets, the smaller end of the spectrum is the more competitive. So 10 to 25,000 square feet, 25 to 100,000 square feet are more competitive across, these 3 markets in general than spaces that are larger. So, this has us thinking a lot about, well, why is this happening? And so that now this is our data. So we took a look at now looking at deals that are under 100,000 square feet and then breaking it up by building size. So you're taking a lease that's less than 100,000 square feet, and what kind of building are you taking it in? So here we divided up into 6 major categories. But you can see that, there's been rent declines across most building size tranches, but actually we saw sort of a slight uptick in buildings that are between 150 and 200,000 square feet, which was kind of interesting. So I think that would still fit, the small bay industrial kind of definition. And here we're sort of breaking it out further. So here we're defining, multi-tenant versus single tenant. You're taking less than 100,000 square feet, and then in what building size are you taking it? And so if you're taking an entire, small bay building, you're taking an entire building that's 100,000 square feet, that would be single tenant. But we saw smaller declines, or in fact, an increase if you're multi-tenant in 150 to 200,000 square foot building. And then even if you're looking at the smaller building sizes, 50K and below, between 50 and 100K, the year over year change was still a decline, but was a lower decline than if you're a single tenant taking a 50,000 square feet building, or a building between 50 and 100,000 square feet. So, a lot of numbers, but I think, what we're seeing here is that there seems to be more of an advantage for, multi-tenant buildings, whether that be that buildings of lower square footage are best, capable to kind of cater to that. We would like to do further research on that, but we thought this was sort of an interesting trend to, point out, and we'll definitely be digging further into it in 2025. Do you agree with this trend, Michael?
Yeah, I think it's a really interesting trend, and I think I think the other thing that I'd love for us to dig into as well, is actually looking at location, right? And how does the impact of last mile, contribute to this trend as well, right? Because we certainly see that smaller bay industrial tends to be more commonly last mile industrial, which has a different type of demand than the larger industrial. But it would seem to me that we should all be buying buildings that are between 150 to 200,000 square feet and carving them into 44,805 square foot spaces. And then we'll be all set.
Exactly. Yeah, no, that's a great point. I think the other major point of this, and why bulk industrial was so hot, is that that was what developers were building. They're building massive buildings and increasingly trying to get, that one mega user, the Amazons of the world. And of course, those buildings are, the location aspect that you said, they're building them, further away from the city center, whereas it was harder to build, and maybe, less attractive to build smaller buildings and then closer to the city center, or just smaller buildings in general. So, I think on average, if we had pulled, building year data, you would see that the small bay buildings that are able to capture these tenants are older, more obsolete. And so there seems to be, real tension on that part of the market, and people focused on the opportunities there.
Yeah, and look, I think the other thing to factor in here is, when you're talking about huge spaces, I don't know, it doesn't matter what the asset class is, whether it is industrial or office or retail or whatever the case may be, it's a less liquid market because there's just fewer of those. But you're also dealing with much more sophisticated tenants, right? And so I think that for if there's very little supply, the sophisticated tenants, while are good at negotiating, understand the reality of that little bit of supply. And then when you have an oversupply in that regard, even if that might be coming to smaller tenants, the smaller tenants may not be as sophisticated or aware of where the trends are going to be on top of it. So I think there's going to be a bit of a lag on how that might impact the rents for smaller tenants. But most of the supply has been in the larger buildings as well. It'll be interesting to see how many landlords decide to carve up some of these larger buildings into smaller spaces, and or whether they're able to capitalize on that, or whether in fact that's not really something they could do because a lot of the smaller tenants want more of the last mile, and most of the large buildings are not last mile type buildings. So there's a lot more to dig into there and try to really make sense of.
Definitely.
Cool. So now we're going to dig into niche commercial real estate sectors for 2025 and where we see things going. But let's dig in here. A lot of charts here.
Yes, we love charts. We are a data company. So yeah, we want to cover subtypes, and subtypes is something that it's not new to real estate, but it is sort of something that everyone's sort of getting used to. So NCREIF, which many institutional players consider the benchmark for understanding returns and vacancy in the market. I think it was last year or the year before that they actually changed the way that they do their national property index. It used to just be core property types, right? And now they've expanded it to all these different sort of subtypes in a recognition that like the market is many more things now, and institutional players are not just looking at office or an apartment, that there's like way more to it. So here we're looking at NCREIF returns over the past 5 quarters and then the 1 year return. What we saw here is that some of these subtype sectors, which I highlighted in red, outperforms or other, more core, certainly office for office. But the outperformer here is obviously data centers, 5 straight quarters of positive growth. Also industrial specialized, which would include things like cold storage and industrial outdoor storage and other kinds of specialty industrial types. Interesting, self-storage was sort of lower, still positive returns, but lower than data centers and others. Is there anything surprising to you here, Michael?
Um, well, we're gonna talk about data centers, which maybe most surprising to me is I don't believe data centers are really real estate. But we'll talk about we'll talk about that in more detail.
So one of the subtypes that we did talk about last year in our research was cold storage. We were asked about it a lot, and cold storage being a specialized industrial type. But we actually saw that in 2024 and even 2023, we started to see, the rents kind of stabilize, not increase any further. While you see that the spread over other industrial rents has significantly widened since 2019, 2020. And I think this happened late last year, but I think earlier in 2024, a lot of excitement over cold storage, and there was I think it was like one of the largest IPOs for the cold storage Lineage Logistics. But then late last year, they said that they were cutting projections and weren't seeing as much growth because of inflation, because of consumers consuming less and that sort of thing.
Yeah, and obviously, the cold storage was heavily driven by um, things like, well, first it was vaccines, then it was, then the transportation of the vaccines, then it was obviously grocery deliveries and people wanted to order that. More recently it's been, the cold chain for GLP-1 medications and things like that. But a lot of that, but a lot of that demand was COVID related. And so there was a lot of, a lot that was built out and to support that. But obviously, you've seen that, seen that chill out a bit. Oh, you get that one? Okay, let's keep going. All right, so we're going to talk about the poll and what CRE sectors you all thought were going to be hottest in 2025, and data centers far and away was the winner, followed by industrial outdoor storage. One thing I'll say, for sure is that niche sectors generally we expect to continue to be hot, and that's, something that I think is relatively permanent, right? I mean, everything in commercial real estate is cyclical, and anything that is not doing well now will do well in the future, and vice versa. We've seen that, in every sector. But I do believe that this trend of real estate investors becoming much more diversified in their commercial real estate portfolios is something that's here to stay. I think they've all realized, particularly when you look at like the pension funds and the insurance companies and those kind of large LPs, that for the kind of returns they're expected to provide and the security they're expected to provide, um, to their investors, they need to have a level of diversification to make that happen. And I believe that trend is here to stay. But let's talk about specifically where we see, the hottest sector. So data centers, we believe, we agree with you, will be the hottest, and we'll talk a little bit why.
Yeah, perhaps it's not shocking at all that we think data centers, despite being up for debate, whether it's an actual real estate sector, being a bit different than every other sector that we talk about. But I think there's a lot of reasons to be optimistic. We've seen major investments announced before President Biden left office. He set an executive order, which I believe is still in place, that federal land can be used for AI data centers. There was a recent announcement about Stargate, which I think you know a bit more about, Michael, about that investment and who's involved.
Yeah, Stargate is really interesting, right? It's a joint venture, effectively between OpenAI, along with SoftBank, and Oracle, to put in $500 billion to build new data centers for AI. Very much lauded. I think it was on the first day of Trump's presidency. They announced this, and so obviously, this is one thing that I think both Joe Biden and Donald Trump see eye to eye on, is investment in data centers and driving growth of AI. But it'll be interesting to see where that demand plays out.
Yeah, I think there's lots of reasons for, demand and sort of powerful people behind it. And we also saw major acquisitions last year. So Blackstone acquired AirTrunk. That was one of the largest data center acquisitions, I think, ever, or at least last year. But this deal made Blackstone the largest owner of data centers worldwide. There was also interesting, several acquisitions of new data center campuses. They're going to be nuclear powered by Amazon and Microsoft. And then the chart on the right shows that M&A activity, not surprisingly, was all-time high last year. So these are all things that we believe are positive signs for data centers. Oh, I forgot to mention one thing, Michael, that the kind of something that could not totally overturn this prediction, but DeepSeek and
Yeah.
the news that it might not need as much. So
Well,
that's kind of an
yeah,
asterisk
I
in
think I
this.
think deep there I think I heard about at least one data center investment deal where an investor pulled out when they heard the DeepSeek news because they thought that there wouldn't be as much need. I think there's two parts to that. One is, will the innovation in this space require, fewer chips and as a result, less data center space? Or in the case of DeepSeek, they're using different, less powerful NVIDIA chips. But the other thing is, everyone was assuming that all of the development around AI was going to be in the US. And so when we look at things from a US centric point of view, perhaps maybe, development of data centers supporting AI is going to be in China and not just the US. So I think that, potentially, brings some risk into the sector. But I think that that goes back to my point before, which is that I don't personally think of data centers as a real estate play. The vast, interestingly, before starting Comstack, I was a commercial real estate broker, and I specialized in data center transactions. And at that time, it was even more the Wild West than it is today, but it is still, kind of a Wild West type industry. And it was extremely clear to me, having worked in that industry, that, the real estate was the least important part. Of these data center developments, right? It's all about access to power. It's all about the infrastructure for cooling. It's all about the equipment that goes inside, access to fiber. So certainly location matters, access to land matters, but there's a ton of money that goes into these data centers that is not what you would consider traditional real estate investment. And the other risk I think that we're going to see in this industry is a lot of people who are in the real estate industry investing who don't really quite know what they're getting themselves into. That said, there's certainly ones who do, right? Blackstone makes their investments in data centers, having acquired years ago QTS, which are experts in the industry and have been at it for a very long time. I think that the bigger risks are going to be the real estate operators who invest in data centers directly or invest through partners that they don't know that well, and maybe get a little bit in over their heads. But nonetheless, we think that there's just too much hype in data centers to stop it in 2025, and it is going to be a big year for data centers.
Be interesting to watch. So I believe we are right at time. We made our under 1 hour target, just barely. So Michael, do you want to share how people can get in touch with us?
Absolutely. Yeah, so you can see all of these beautiful icons. And so you can go to our website, or you can go to LinkedIn, you can go to YouTube, you can listen to our podcast, which is the Not Podcast podcast, which is a clever name for something that actually is a podcast. And all sorts of social media. We're on it. And we're very exciting on social media. But you can also feel free to email us. I'm Michael at Comstack.com. Ellie, you are Ellie Bowman at Comstack.com, right?
Yeah, that sounds right.
Yes.
Or you can, more simply, you can reach us at marketintel at comstack.com.
Even better, even better. But we're reachable, and we will try to follow up on some of these questions, but we're out of time, so we're not going to answer them right now. But hopefully you enjoyed it.
Thanks, everyone.
Thank you.